Joining us now is Eric Mandl from Guggenheim. Eric, I mean, you got Warner Brothers Discovery, you've got ServiceNow that just closed a deal and is rumored to be doing another one. What's driving this pace? Why do you think it can continue?
Yeah, it's great to be here with you, John. Morgan, thank you for having me again. There are two things going on right now that kind of feel like they fly in the face of one another, but creates an environment that likely drives more M&A. The first is we have this massive AI boom. And I know we'll talk about that a little more, but let's just take it at face value that it's a boom. On the other side, we have a tremendous amount of self-imposed pressure by CEOs of how are they going to be able to do two things at the same time: grow and generate free cash flow. Now, when you combine all of that, right, you've got the stress of trying to keep up with what's happening in AI, and you combine that with the need to grow faster than you typically do in an organic fashion. It's a perfect recipe for M&A.
What happened to the valuation hesitation that was keeping M&A from happening before? Is it just that the big names got bigger too, so it's like everybody's big so they can buy? And does it mean that if we get a downturn in the market, which is likely to hit the smaller names and maybe the private names harder, that'll make even more M&A happen?
Phenomenal question and perfect setup. So if you are in the boardroom right now, not only the CEO, you're in the boardroom, you actually have a fair amount of responsibility, especially if you are one of the mega caps, one of the Magnificent Seven, and the next 10. So think like ServiceNow, IBM, Cisco, many others. The amount of pressure that you have to be able to not only solve what your customers are asking you to solve, but your desires for the next 5 years. AI has changed the way in which people need to forecast. It's not really a baby shift. It really is a seismic shift. And I love the way you asked the question. As an investment banker, we spend a massive amount of time with public companies, spend a lot of time with private companies. And, you know, I think next year we're going to see some true IPOs. I thought your interview with the Databricks CEO was really fascinating. If I was a betting man, I think something happens in 26 rather than 27. But private companies are most interesting for the following reason. This is a statistic that, you know, when I remind myself of it, it's a little daunting. We have over 1,000 unicorns, and they are valued at $5 trillion. So if you do quick math,
wow,
right? 1,000 unicorns, oh, so they're each worth $5 billion. No. The vast majority of them are now worth less than the value that they were marked when they raised capital. So they're not even worth $1 billion. They're called unicorns because they're marked at that level, but they're much lower. That doesn't mean they're not great companies. That doesn't mean they don't have great talent. But what it does mean is the likelihood of them being able to get public is very low. And that massively opens the M&A floodgates to them.
It's interesting you say that because that's exactly where I was going to go with you. We have a couple of potentially high-profile, very big-ticket IPOs on the horizon for 2026. We've got one that has nothing to do with tech or AI, pricing for tomorrow with Medline as well. And that is, it hasn't been a great year for the companies that have gone public. Maybe it has been on like day one or day two, but a lot of these names are actually trading lower than where they were with the IPO price, or they at least have come back down to earth. So how does that, I guess, lend itself to a setup for 2026 in that going public pipeline?
It's a phenomenal question. You're right. I think there were a bunch of things going on in 25. The tariff trade sort of eviscerated the first quarter, and it took a long time to recover. There were a lot of companies that wanted to go public, and they just were not able to. I've been doing this for a few years. I remember back in the day, you'd have 20 IPOs in a week. You know, now we don't even have 20 IPOs in a month sometimes. So I think we're going to get closer to that, and I think there's also a desire to get out there for portfolio managers. They want to deploy capital. If you've owned NVIDIA, you know, it has its ups and downs. It's a wonderful thing to own. But if you want to play the specificity of one little specific area of tech or media, telco, you have to own an IPO. And also the good news is sometimes when businesses go public, it's actually a path to them becoming breakout companies. CoreWeave has had its ups and downs this year. It's up since its IPO. It's in an area where, at least as an investor, you have the ability to play that upside.